Welcome everybody to an easy algo training. In this training today, I'm going to be showing you how to use the TDI X to discover the bias of the market, how to identify the trend of the market, and then using indicator X for entries as well as TDI X for entries. This is going to be a very unique training, and I'm going to be showing you some things I haven't revealed before, which I believe is going to be extremely helpful. Let us dive right into the charts. So if you open the charts here, you can pretty much open any token that you want. Over here, I'm looking at UX Link USDT. It is a new coin, but it's also making some very good moves in the market. And I'm just going to be using it as an example. You could use Bitcoin or any token that you wanted. In the indicator X strategy that we teach, our main focus, our step number one, is identifying the bias of the market. How do you know what direction the market is moving in? This is step number one, the most important thing. And pretty much one of the most important steps for any trading strategy is how do you know the direction of the market? Well, the TDI X makes it super easy to be able to figure that out. And I'm going to show you a little technique, a little strategy that I've figured out. And I've talked about it before, but this time I'm going to bring it into the indicator X strategy and show you how you can use these two together. I teach a lot of different methods on how you can discover the bias of the market, whether it's using trend X, imbalance X, whether it's using market structure. But this time I'm going to focus on how to do that with TDI X. So if you look at the TDI X here, guys, I'm going to show you something. You can see that we've got these white RSI line and it's moving up and down. And then it's crossing this yellow middle line. So if I take away these Bollinger Bands for a second, you can see if I just take away the Bollinger Bands, and then I'm going to remove the divergences as well, basically going to remove everything except for this white RSI line and this yellow line. This yellow line, guys, if you open the settings over here, you'll see it's the middle band. The middle band is also a sentiment analysis. It shows you what is the sentiment of the market. So for instance, if you can see, if price is below it or breaking below it, it means it's going into a bearish sentiment. If price is breaking above it, it means it's going into a bullish sentiment. And remember, when we want to identify the higher time frame, we've got to do this on a higher time frame. I like to do this on a 1 hour. You could do it on a 4 hour if you wanted, an 8 hour, all depending on what kind of trading style you like. For instance, I do it on a 1 hour if you want to look for good scalps or just smaller swings. If you do it on a 4 hour, you're going to get much bigger swings. If you do it on a daily or a 12 hour, then you're going big swings. So all depending on trading style, the strategy will stay exactly the same. The only thing that will change is the time frame that you're doing it on. For this example, I'm going to show you how to use the 1 hour for your higher time frame and how we can use the 5 minutes or the 15 minutes or even potentially the 1 minute for your entries. So step number one is we want to determine what is the TDI X telling us about the direction of the market. So if we look back in time, you can see it crossed above the middle line over here, over here, over here. See, so all we're doing is we're just paying attention to when does it cross above the middle line and when does it cross below the middle line. You can see over here. Now there's a few different ways to run this strategy, but I'm going to keep it really simple in this example. If, for instance, you see we're on the 1 hour now. If we had to go on the 4 hour, you'll see, look how different it looks. So you can see on the 4 hour, it's going to show much bigger movements. So you can see this was the place where it crossed the line or over here. So for instance, I'll show you the difference. I mean, this will blow you guys away. And you'll see here, this is where it finally crossed below over here. So now if we go into the chart, I'm just going to clear the chart of everything just for this example. If you can see here, so this was the point where it crossed above and then it kind of retested. If we just move it up, this is where you can see it is above the yellow line. So from here onwards, you can see it made a very big move. You can see it did like 20, almost 30% move. And then now on the 4-hour, it's broken below it. So we use this to give us information of what is happening in the sentiment of the market. If it breaks below, then it's best to just look for short positions. If it breaks above, then it's best to look for long positions. And now you can use this in combination with other strategies as well. So for instance, this can be just another confluence that you can use to get an understanding of what is happening in the bias of the market. So if we're going to go based on the strategy I'm showing you today, I'm just showing you that if we go primarily off the 1-hour chart, every time it breaks below, we're going to mark a line. Every time it breaks above, we're going to mark a line. So I'll just use this as an example. I'll show you how to back test with this as well. So you can test it on your charts and you can see every time this happened, we got very good results. It gave us very confidence. And there we go. Okay, so look here. You can see every time we got across above, look, it made a big movement. 9%, crossed above, 8%. This is where it crossed below over here. So it crossed below, and we got 5, well, it came all the way down here, 9%. So you can see if you're using the 1-hour, you're going to get like 10% moves. If you're using the 4-hour, you're probably going to get like 15 or 20% moves. If you're using the daily, then you're going to get very big moves. Like, look, if we go into the daily for a second and we just do this on the daily, you'll see this is where it broke below. Can you see? So I'm just marking broke below, and this is where it broke above. And you can see over here. See, the daily won't give as accurate information, but it will be solid information. So you can see it broke below here and it dropped 35%. This is the point here where it crossed over. And it's done about, hasn't done too much now, only 11%, but potentially has a lot more to go. So you see, so if you're doing it on a daily, it'll take a lot longer for it to play out. That's why I recommend the 1-hour. If you're just looking for, smaller trades of like 2 to 5%, the 1-hour is going to work perfectly with this strategy. So you can see here. Sometimes you can go to the 4-hour and just have a glimpse. So you can see if we go on the 4-hour, we know that at this point it's broken below. Can you see? So then if I go to the 1-hour and I have a look, then I know from this point it's broken below the 4-hour and the 1-hour. So if I go to the chart, this would be a fantastic place to start looking for shorts. And then what you would do is you come onto a lower time frame. I like to use the 5-minute for entries or the 15-minute for entries. It's a very good time frame. So let's just go. So what I'm going to do is I'm going to create 2 screens just to simplify this. I'm going to create 2 screens. The one is going to purely have indicator X. Over here, indicator X, TDI X, and then over here, I'm going to have the indicator TDI X over here as well. So we're on the 1-hour chart, and you can see I'm going to mark a line. This is the place where I'm looking for my long entries. This is the place where I start looking for short entries. So guys, if this white line is underneath the yellow line, you're only looking for shorts because it's showing you it's in a bearish sentiment. If it breaks above, then you're only looking for longs. It's in a bullish sentiment. But remember, guys, this is more of a continuation strategy. If you were a reversal trader, you're going to catch the reversal down at the Bollinger Band over here. But this is more continuation. This is more saying that at this point, price has gone into a bullish phase, and from here onwards, it's most likely to move up. So if you're looking to catch reversals, it's best to look for reversals at these shark fins that the TDI X produces. But this strategy I'm showing you now is primarily continuation trading. It's a lot easier and a lot safer to do this trading because it confirms it. So we know when the white RSI is above this yellow, it's confirmed now that this is going into a bullish environment. So if we mark it on the chart over here, this is precisely the place where it was marked out on this zone. So it's nice because I can be on the 1-hour over here, and then I can be on the 5 minutes over here. So you can see I'm on the 1-hour time frame on my left, which is my higher time frame bias, and on the right, I'm on the 5-minute, which is my entry time frame. So now I want to put on the chart indicator X, because indicator X is going to show me the best places to look for my entries. So now that we know from this line onwards, we're only looking for long entries. And the only times we're going to look for long entries is when we get price underneath these value lines. Remember, the value lines show you where true market value is located. And your best long entries are always going to be when price is underneath the value line. Here we go, is another place over here. And here would have been another place over here. So you can see on the 5-minute chart, we had 1, 2, 3, 4 entries that we could have taken into this uptrend, because we know it's in an uptrend. Look, it's above the yellow line. It's above the sentiment line. So we know it's in the bullish sentiment. So it means over here, it makes things super simple for us. We're only looking for our long entries. Now I'm just going to add the liquidity lines, because the liquidity lines can help us understand targets. And for this style of trading, there's a few different ways you can do it. You can enter then extra liquidity line and do multiple trades if you're a scalper, or you can enter and hold it for a longer swing up, depending on how you like to trade. But with this strategy, if we're using the 1 hour as the higher time frame bias, we can't hold it for too long. You can hold it for maybe 5 or 10%, and then there's possible chances of reversal. So then what you want to look for is you want to look for divergences. So since we're in a long position here, we want to look for a bearish divergence to happen on the 1 hour, because a bearish divergence could let us know that price is going to reverse. Or what we can do is, when we can see on the higher time frame bias that we're getting a shark fin, this could be a place where there will be a retracement back down. And this is why it's nice to use both of the TDI X's, one on the higher time frame and one on the lower time frame, because you'll see if I put on these Bollinger Bands over here, it keeps you on the right track, guys. I'm going to show you how using the TDI X just keeps you on the right track, helps you make good decisions. If we know that we're in a bullish environment now and we're only looking for longs, remember, this is an important thing, because so many times you might be shorting the market, but it's actually a long market, or you're long in the market, but it's actually a short market. So by doing this, you're sticking to a one-sided bias. You're saying to yourself, I'm only looking for longs, because you confirmed that the market is going long. So there's no shorts involved, only looking for longs. Then if we come onto our entry time frame, if we want to make sure we're going to get a good entry, the best entries are always on the pullbacks of the uptrend. So the market is going up and up, but every time it gets a pullback, we want to look for an entry. So we're looking for pullback entries. The TDI X on the lower time frame is going to show you where you get those pullback entries. Every time we get either a shark fin happening, and a shark fin is where we get this white RSI line break below the Bollinger Band. You can see this is what we call a shark fin. So this line over here is the same line that's on this chart over here. It's just keeping us in perspective. This line is this green line over here. So you can see every time we're going to get a shark fin, or the white RSI line is at the low of this. If you look over here, if we zoom in here, I want to show you this. So you can see we've got the red line at the top and the green at the bottom. The green at the bottom is showing you when something is oversold. The red is showing you something when it's overbought. The best time to enter on the pullback is when price comes closer to the oversold regions. When it's the oversold regions, there's more likelihood of it continuing and completing the retracement. So we'd look for an entry at this shark fin. We'd start looking for entries down here when price is getting to these low areas. These are the places we want to start looking for these entries. You can see that this is a very nice entry, a shark fin. You see, so we've got two different aspects we're using at once. This one over here, the bias is just helping us know what direction the market is moving in. And then this one over here is just helping us get the best entries into those pullbacks. And I'll show you over here. So we know that the market is going up every time price is under the value line. Can you see under the value line? And we get a shark fin, that becomes our precise entry. And that would have been a fantastic entry, guys, if we got this entry. Let's zoom in a little bit here. If we got this entry, our first target would have been the value line for 1%, and our second would have been the liquidity line, which is 2.9%. That could have been the trade done, could have been out. If you wanted to keep holding, you could have kept holding and it would have gone a further 5% for you. But there's more risks involved, and sometimes it doesn't always do that. So it all depends on what kind of a trade you are, what time frame you're trading on. If you're trading on a 5 minute, it's best to get in at the bottom of the value line and get out at the top of the value line when price hits a liquidity line. So this would have been my setup in this scenario. I would have entered my long position. Stop loss would have come under the swing low. Target 1 would have been the value line, and target 2 would have been the liquidity line. That would have been the perfect setup, because if you look, guys, we've got a very tight stop loss. So if price goes against us, we're losing 0.58%. But if it goes in our direction, we're making 2.68%. So it's a risk to reward ratio of 4.6. That's what's great about the strategy, is you're risking a little to make a lot. So if you lose, you only lose a little. And if you win, you make a lot. So one win can make up for like 4 or 5 losses. And when you add this up through probabilities, you end up winning in the long run. If we move on, we got another scenario where this happened. You can see price was underneath the value line. So all we're doing is we're waiting for value lines to be produced. You can see over here, value line being produced. We got a contraction box over there, and then price is underneath over here. This is the place we're looking. You can also see over here, we've got price, the white RSI is at the low of this range. It's getting close to the green line, and it's finding some kind of a support. Look at this. It's finding a support here. Can you see? So we can also use the RSI in the same way that we use price. We can also measure this in the same way we use price, and I'll show you another strategy of how we can do that in a moment. But you can see price is finding support. It hits this level once, or if I move that up, hits it once, twice, breaks it. Then as it pops back up, we could have looked for an entry over here. I mean, it all depends on how you trade and what kind of criteria we look for. You can see we've also got a reversal candle, a Morningstar candle over here, which is a reversal candle. And these candles often show that reversal in price will occur. So we can take multiple aspects into combination. If the picture is not clear, always go up a time frame or go down a time frame. That's all you have to do. So look here, we just moved up from a 5 minute to a 10-minute time frame, and I want to show you this. Look how much clearer this looks. Look how much clearer that looks. So now we got a very nice shark fin. If you guys don't know what these shark fins are, make sure to go through the TDI X manual, the TDI X training. These are letting us know, these are signals that are letting us know reversals have a high potential of occurring. So it's always important, if something's not looking clear on one time frame, remember we're on the 5 minutes, it wasn't looking clear. Look, we didn't get that much clarity on the TDI X for our entries. So then I just moved up to the 10 minutes and things became a lot clearer. Look at that. Now it's super clear. Not only do we get a reversal candle, but we also get a shark fin. So it's important just to pay attention to these little details. If we keep going, so now I'll go back to the 5 minute. I like to always look on the 5 minute. I like the 5 minute because you get a lot more entries. But if you like to enter on the 10 minute, the 15 minutes, anywhere around there, I usually will look at the 15, the 10, the 5 minute, and I'll just kind of flick through those and see which one looks better, because one time frame is going to look a lot better than another time frame. So you can see we move on. Here's the next place where we get a contraction box. So we get a contraction box, we wait for price to come underneath, and you can see over here, price is underneath in this region. And remember, if you want to keep checking what's happening on the higher time frame bias, you can. If we go and have a quick look to see what's happening at this level, you can see we're marking out this level on this side of the chart. There we go. So it's basically over here. And you can see it's breaking below the Bollinger Band. So usually at this point, price is going to travel down. You can see, look, it did travel further down. This could have been an entry. It could have been an entry, and I'll show you how we could have taken it. Because we got a very nice shark fin, can you see? The white RSI broke out of the Bollinger Band, forms a nice V, comes back in, as it comes back into the Bollinger Band, that can become a place where you look for an entry. In this example, would have been tricky because you could have taken your entry over here. Let me just mark out the setup. You could have taken your entry like this. There was a nice candle over there. And then price went up and it did touch the value line. So remember what I always say, the safest place to enter this and to exit is at the value line. The next would be the liquidity line, but this didn't go that high. It came, touched the value line, and then it dropped. So if you had taken profits at the value line, you would have gotten out with 1.43% profits. Because remember, you always want to keep observing the higher time frame bias. So we can see, if we can see price breaks out into this bullish shark fin, this bearish shark fin, and breaks below the band, this is letting us know now that potentially price is a lot further to go until it comes back down to the middle band, the sentiment band over here. And this can be a place we can start looking for an entry again. So if I mark out that area on this chart now, it comes about over here. If I mark it out over here, it comes around here. So you can see this was the place, a little bit closer there. There we go. This is the place where we can start looking for a long entry again. And you can see something I noticed, and something to pay attention to is also looking for divergences. Can you see? This is a divergence. The oscillator is going up, and you can clearly see that price is going down over here. So we always want to keep a very close eye out for divergences. Divergences is an amazing signal. It often has a high probability of playing out in your favor. Whether it's a higher time frame divergence, it has a lot more strength to it. And if it has a lower time frame divergence, you want to trade that divergence in alignment with what's happening on the higher time frame bias. So let's go into a little bit of a higher time frame, and let's just see if we can get a clearer signal of what's going on. So here we go. So you can see we've come onto a higher time frame, 10-minute now, and you can see we get a very clear shark fin. So that is a very confident signal that this could have been the place to enter this position. We would have entered at this point when price, you can see this engulfing candle, would have stepped stop loss just underneath the candle. Target number one would have been the value line. Remember, the first target is always the value line. Price loves to oscillate around these value lines. You have a high probability of price always going back to the value line. The second target would have been the liquidity line. I just want to add more sensitivity to these liquidity lines. So you can see there will be more of them that will be produced on the chart. There we go. So you can see this would have been the first liquidity line over here. And price hit that liquidity line. If we'd aimed for this high liquidity line, price did not get that far yet. So we could have exited the trade at the first liquidity. The first, remember, place is value line. The second is the closest liquidity line. So these are two things you really want to pay attention to. In this scenario, we would have got very good results. So this is where we're at in this scenario. This is up to the live time at the moment. Price is above the sentiment line on the higher time frame. So for us now, if we're looking for new trades in the future, we're waiting for price to come underneath these value lines. So say, for instance, price comes under this value line again, like this. Say it breaks under here, then potentially going to be looking for a long entry when price is under the value line. Or we'll wait for a new master pattern to form. We'll wait for new contraction box to form, and then we'll wait for price to come under the value line again, because we know on the higher time frame, we are above the sentiment. We are above the sentiment, which means we're only looking for bullish trades. So this is how this would play out now. We'd wait for price to break underneath the value line, or we would wait for a new master pattern to be created. Since we're on a 10-minute time frame, if we had to go to a 1 minute, you'd see this same scenario I was just showing you now. There is so many more entries. Like, look at all these entries. Every time price was underneath this value line over here, would have been an entry, would have been an entry, would have been an entry, and this would have been an entry as well. See, so going on to a lower time frame, you're going to get a lot more possibilities, but there potentially will be smaller trades, 1.7%, 1.5%, 1%. which is totally fine, guys. If you're getting 1 or 2 or 3% per trade, that is fantastic, because you can do this a few times a day. And trust me, it adds up very fast. It compounds very fast. Sometimes just looking to take a small piece out of the market, getting out, ready to reload and do it again is the better thing to do, especially in markets like what we're currently in, where price goes up and then down and up and then down. We're in more of this choppy ranging style. Every time so far, it looks like price wants to break out and take off in the crypto market. It hits a resistance point and it drops again. So we haven't gone quite into that old season Bitcoin run, yet. So we just have to trade accordingly. And this strategy and these tools are the best ways to trade in these kind of market conditions. If you're just getting in for your 2 or 3 or 4% and getting out, getting in for 2 or 3% and getting out. And oftentimes you end up making more money when you target smaller percentages, because it's a lot safer to take a 1 to 2 to 3% and then re-enter than to try and aim for a 5 or 10% in the market. Obviously, depending on the time frame you're entering on, but it all depends on the market conditions that you're also in. So let's keep going with the strategy. Let's back test some more. So what I recommend for you guys to do is open your chart here, back test this. So you'll see over here, let's back test the shorts now. So at this point, you can see on my 1 hour, this is when the white line has dipped below the sentiment line, this yellow line. So from this point onwards, we're looking for shorts. I'm going to come on to the 5-minute time frame here, because I like the 5-minute. 1 minute's great, but sometimes it can be diluted and you can miss opportunities, because where the lower the time frame you're on, the more diluted, the more fake outs you get. The higher the time frame, the more confident you can be. So I'm just going to take off the liquidity lines just so it looks a little neater to show you guys. And I want to find this area on the chart so I can mark it. Okay, there we go. So from this point onwards, I'm just going to also move this back a bit. Fantastic, fantastic. So we go. So from this point onwards, you can clearly see that the white line is below the yellow line. So we are in a bearish sentiment from here onwards. So we know now I'm not going to look for any long positions. I'm not going to try catch any reversals, because remember, if I now start looking for reversals, I'm switching my mind into reversal trading. And remember, the traders who have one strategy and they just stick to that one strategy, where you're only looking to trade divergences, or you're only looking for reversals, or you're only looking for continuation, they have a higher success rate, especially if you're not that experienced. When you have a lot of experience, sure, you can catch reversals, you can hop onto continuations, you can do divergences, break in structures, all that kind of stuff. But if you're kind of new to trading and you've been trading for like a year or 2 years, I recommend just sticking to one defined strategy and just looking for those criteria before you enter trades. Okay, so from this point over here is where the market has gone short. So we're only looking for shorts when price has crossed this line, because we confirmed on the TDI X, guys. It's letting us know here the sentiment that it's moving into. And of course, you could also use, we could also put Trend X on our charts and get more data, or you could also use Imbalance X and get more data. That would definitely help you a lot. If you understood how to use it correctly, it could be another layer of confidence. But if you don't know how to use it, then just stick to one confidence at a time, because it can get confusing if you overlaying your chart with all these different confidences. You're looking at everything at once, So sometimes it's better to just pick a few. I'm trying to get this to play now. Show all. Okay, so you can see. At this point we're above the Trend X. So we are in a bullish frame, but there's obviously a point where a reversal occurs. And this is what TDI X is going to help us identify. So at this point, the true reversal happened at the divergence point. Can you see here? So this was the divergence. And remember what I told you guys, divergences have a high probability of playing out. This is a 1 hour divergence. And this 1 hour divergence happened exactly on the tip over here. So if you were just looking for divergences, you would have caught the top on this trade. And guys, the TDI X is very accurate with divergences, very accurate. So if you saw a divergence, this could let you know, okay, the market is turning now, the market is reversing. And then if you saw the RSI break below this yellow line, this can be a confirmation now that price has gone into a bearish sentiment now. And you can see you would have got, if you'd entered on the divergence, you would have had a much better entry, but now this is the continuation. So the divergence is the reversal. The white RSI line breaking below the yellow line is the continuation point. So this would be the continuation point. This can be the point where you confirm from here onwards, you know the market is going into a bearish state. Now that we have that clear, we can just open our entry timeframes and our entry TDI X over here, and this helps us get more precision. So we know from this point onwards, we're only looking for shorts when price is above the value line. Only time, shorts when price is above the value line. And you can see we had quite a lot of opportunities actually to catch a short here. A lot of opportunity. Has another one. If we play the chart a little bit more, okay, let's just stick to that for now. It's perfect. So these would have been fantastic entries. Remember, the closer you can enter to this bearish sign, the closer you can enter to price, if I just zoom in here, the closer you can enter to this white RSI breaking below. So you can see it breaks below. We're confident underneath at this point. Once you're confident underneath, the closer you can enter to it being underneath, the better trades you're going to get, the bigger trades you're going to get, and the safer your trades are going to be. So from this point, yeah, I mean, this could have been an entry from the start. You can see we get this confirmation line. Then we know that this is one of our entries over here. If we open the TDI X for confirmation, look at that. We got a great confirmation. You can see we got a shark fin happening here. The shark fin is letting us know that there's a reversal, a bearish reversal occurring. So that could have been an entry. If we move on over here, you can see we got another shark fin over here, another two shark fins, which potentially was at this point and at this point over here. So this could have been another place to look for a short entry and would have caught. You can see, guys, if you'd held this too long, you would have lost. Price would have come back and hit your stop loss. So at this point, if you'd entered here, the best place to exit was going to be at the value line first for 1% or at the liquidity line, which would have been 2%. That's why I always say target the value line, take profit one, or the first liquidity line, exit your trade completely, wait for the next setup. And then you can see here's another setup. So we got another shark fin occur over here, right over here. That could have been potentially an entry. Or we got a divergence occur. We got two divergences. This is our first divergence. So we could have entered on this divergence. Or our main divergence, which occurred over here, from here to here. And then this would have been our entry. So any one of these could have been a great short entry. And you can see if we'd held it, price would have taken a drop all the way down 2.5%. So 4 entries, I always like to say, whichever one of these you enter on, the stop loss goes just above the highest swing high points within that segment. And then you're targeting, the value line is target number 1. Target number 2 is the first liquidity line. And if you don't know how to work out these liquidity lines, it's basically the swing low points. So you can see if I zoom up over here, this would have been a liquidity line over there. This would have been a liquidity line. If you can imagine where every trader places their stop loss levels, these are liquidity lines. So you always want to target the places where other traders put their stop losses. This is the potential areas where we have resting liquidity. So you can see these two lines I've drawn here are liquidity levels where other people are most likely to place stop losses. You know, guys who went long over here, they put their stop losses in these positions. And then for you over here, first target is value line, second is liquidity line, third is next liquidity line. And that's kind of how you focus on doing these trades. But if we move on a little bit, you can see here we get 2 more very nice shark fins. 1 shark fin, 2 shark fins. So these two places would have been fantastic entries. This would have been one entry. This one potentially would have been taken out because look, it zigzagged, then shot up. But it doesn't matter. You would have maybe lost a small percentage on that trade, and then you would have re-entered on this one, and you would have made a very good trade. You see, so oftentimes it's okay if you get taken out of the trade. It's okay if your stop loss gets hit, because law of probabilities says that if we keep doing this strategy, we win one, it affords us 3 or 4 losses. You have more, even if you win 60%, you still end up winning in the long run. If we keep going, you can see the next opportunity we got was over here. You can see we got a shark fin there, and the shark fin happened here. We're above the value line, so this would have been a very nice entry. Very, very nice. If we keep going, you see we're looking for shark fins. Here's another shark fin. This was not above the value line, so it wouldn't have matched our criteria perfectly, but it was still a very nice shark fin, and it could have been a very good example of a trade. If we keep going, Here we may have not taken this entry because we didn't get a shark fin, so it's like there's a lot of criteria we're waiting to play out, and once it all plays out, I think let's take this away now. So then if we go back to this point, this was the point where it dropped down, and you can see, look, if I zoom in here, okay, I'm going to show you guys another method that we can use this for. We can use it the same way we would mark our trend line breaks. So you can see if I draw a line at the top, this would be a trend line break. Can you see? Maybe there's a trend line break. So as it breaks the trend line over here, or this RSI line, this is a potential place where price will want to go up. You can see here. Only a small section of it moved up. What are we on the 1 hour over here? So let's quickly look at the 4 hour, which is the 240 minutes, just to have a look so you can see over here. So if I just go to a higher time frame 4 hour just to see what's going on, this is the point where it's confidently underneath. Can you see? This white RSI is underneath this yellow line. So at this point, we're confirmed it is very, very bearish. Then now I can go back to the 1 hour, because I'm just going to a little bit of a higher time frame to get an understanding of what's going on. So I know it's actually very bearish at this point. So I'm actually only want to look for longs. I'm not even going to consider looking for, I only want to look for shorts. I don't even want to consider looking for longs at all until price at least gets above this level over here. Then I'll start looking for long trades again. So from this whole level over here, if I go into a 15-minute chart, I'm just taking you guys onto different time frames to just show you the variation. If I just want to turn on the green. Actually, I'm on the wrong chart. This was my entry chart over here. See, so I don't want to get too confused. I'm going to use this one purely for my higher time frame bias, which I'm just using the TDI X. This one is purely for my entries where I'm using both of them together. So you can see over here, what time frame am I in? 15 minute. Okay, this I want to stick to the 1 hour. So you can see from this point. So now what I wanted to show you is you could draw a trend line over here. And you can see if price breaks these levels, it could be areas to stop your short positions. So if we look over here, when would be the place to stop the short? The short position should have been stopped. You can see around about there. When price, if I zoom in over here, can you see? Now that we've marked this out, you can see this was clearly the trend line being formed. You can see, look, trend line being formed, trend line being formed, trend line being formed. And then this was the point where price broke above it. Can you see right here? So I'll mark this point out right about there. If we go onto the chart over here and we mark it out, you can see this is primarily the place where you want to stop your shorts because the market could be reversing against you now. If we go onto this chart and I move it into the same place, you can see this is where the market turned against us. So if you had looked for a short trade, you could have still taken a short trade. Yeah, actually, you could have taken a short trade, but it did not go back to that line. So it's showing us now that the market sentiment is changing. Because also look here, you can see that we get the succession of value lines. Value lines is also a great thing to look at. If you can see here, all of a sudden we get this value line, then this one is higher, this one's higher, that one's higher. It's showing you it's going into a little bit of an uptrend. So when you can observe this succession of value lines or value lines below each other, it can tell us if it's ascending or also descending. So it's also something that you can also use to keep an eye out for on how these things move. So now I'm just going to do this again. I'm going to take you onto another chart. So let's look at Bitcoin chart. Bitcoin's a good chart to look at. So let's analyze, where is Bitcoin right now? How is it looking? Okay, so let us first do a little analysis on a higher time frame. So if we're on the 4-hour, we can see, you can see confidently on the 4-hour, we are underneath the sentiment line. I'll just mark that out clearly. From this point onwards, we're clearly underneath there. So on the higher time frame, we are in a very bearish zone. And you can see from the moment we got this cross below, look at this. From the moment we got it, Bitcoin made this massive drop, and we've seen Bitcoin go down 5%, which is quite big for Bitcoin. But now if we go to the 1-hour, you can see we still keep that in mind at this point. If we go into the 1-hour, we would have actually got a better entry. Look, the 1-hour crossed below over here, whereas the 4-hour crossed below over here. So at this point onwards, we know things are very bearish on the 1-hour. If we just want to do little scalps in the market, you can see here, look, this gives us all the clues. Look here, first of all, we get, what is this, guys? This is a bullish divergence. So this is showing us that there's a reversal occurring, a possible reversal occurring. And this bullish divergence happened over here. As soon as we got this, we did get a reversal, because divergences are reversal signals. You can see we got a reversal over here. And then we got the line crossed over here. At this point, we got the cross. I just want to change this all green so you can see, bullish. So there we go. We got the divergence. Very shortly after, we got this continuation, and now price has gone into a bullish phase within the sentiment. So once we saw this, at this point, we can be pretty confident that we're only looking for long positions. So then we turn on indicator X, and you can see I'm on the 5-minute chart. So this would have been our notification at this line over here. From this line, we're only looking for longs. And then, guys, this would have been a fantastic entry right here. Look at that. Another fantastic long. Keep going. Another long over here. Another long down there. So now we want to open up our entry TDI X and our entry indicator X. And now we're looking for confirmations. And remember, if it's crossed the line on the higher time frame, remember this is the 1-hour line over here. This line represents the 1-hour sentiment, letting us know now that price is in an uptrend. It's gone into a bullish environment. So we come onto the lower time frame that we're on now, and we're looking for long entries when we're getting these pullbacks. This is a pullback happening over here. You can see the pullbacks let us know when we get these super shark fins or these shark fins. That's letting us know that price is retracing, below value. And this is the precise methodology and strategy of indicator X. The next one we get was over here. You can see it was a very small, this wouldn't have been such a clear signal. So we could have dropped to a lower time frame, or we could have skipped that and waited for a clearer signal. Let's see if we jump onto the 15 minutes. Look at that. So if I jump onto the 15-minute, look how clear it is there. We got a very clear shark fin, very clear, very nice shark fin. But on the 15-minute, price did not even come below this value line. Look, it stayed above there. So let's go to the 1-minute. I'm just showing you how it plays out on different time frames. So look here, if we go into the 1-minute now, look how clear it is. Look how clear it is. Very clear. We got a super shark fin happening. Super shark fin happening over here. Very, very, very clear for us. Very easy for us to have taken this. If we wanted to look for an entry, we would have entered. Remember, the entries are always when the white RSI band comes back into the Bollinger Band over here, or just at that point over there. So, and you can see we got an engulfing candle. So at the engulfing candle, we could have set our entry. Stop loss is under the swing low. So I'm just going to show you under the swing low. First target is always the value line, first target. Second target is the first liquidity line. This is the first liquidity line over here. Because remember, liquidity lines are placed on the swing high point. So you can see over there. That's a swing high point. So that's a liquidity line. So this would have been our second take profit area at that level. And you can see price hit it, then retraced from there. All right, guys, let me recap the strategy just so it makes complete sense to you all. So first thing you want to do is step number one, we want to look for our TDI X bias. The TDI X bias is what I'll explain to you. If you're on the higher time frame, over here on the 1 hour, you can see if this wide RSI is above the middle line and clearly above it, then we're only looking for longs. If it breaks below it, we're only looking for shorts. However, you want to make sure that if you're entering longs at this position, once we get our bearish shark fins over here, that we can exit our positions, because then we know there could be a retracement or a reversal happening at this point. But the clear breaks as close as we can enter to when this white line breaks and we can confidently see it above this middle line. That is when we know price is going to be moving into an uptrend, especially when we're doing this on the higher time frame. If it breaks above the middle line, we're looking for longs. If it breaks below the middle line, in this example, we are looking for short positions. I like to use this on the 1 hour. It suits my strategy, but you can do 4 hour, 6 hour, 8 hour, whatever kind of a trader you are. That's step number one. Once you have confirmed the bias of the market, so from this point over here, you would have confirmed at this line, I'm only looking for long entries. Then you open your indicator X, which is these value lines, and you can open the lower time frame TDI X. Now we want to make sure we want to enter our long positions when price is under the value lines in combination with shark fins. Because remember, shark fins are letting us know we get a retracement on the lower time frame in the uptrend, which we spotted on the higher time frame with our higher time frame bias. Because remember, the higher time frame is the movement of the wave. If the wave's going up, then we're looking for the best entry in that uptrend, which is going to be the retracement. So that's why we use the TDI X shark fins. And when price is under the value lines, because when price is under the value line, it's letting you know it's the highest probability that the retracement will happen in this location. So combine this strategy together, use it as an extra confidence on what else you already know. I've really started playing more with the TDI X. It's got so many functions, guys, so many functions to play around. And this is just a very nice one to keep you on track. If it's above, you're looking for longs. If it's below, you're looking for shorts. But remember, if it gets very high, the reversal will occur. Like for instance here, this would have been the place to start looking for our short positions right over here. But then as it gets down and we start getting this shark fin, this bearish shark fin, this is potentially where you want to actually stop looking for shorts, because the price could start reversing at this point. So keep the strategy in mind, back test it a ton of times, forward test it, apply it into what you already know as an extra confidence. I know it will definitely help you stay on the right side of the market. I'll definitely be going into more videos. I've got some other ideas of other TDI X videos that go into more explaining this example to make it clearer for you all. But hope you enjoyed the video. Test it out, send me feedback, and happy trading, everyone.